Hello and welcome to another edition of 9 to 5 Live. The question this morning is, can the Magnificent Seven stocks continue to match and beat expectations? If in the future, in the coming earnings season, they only match expectations, will the market take that as a negative? Hello, Francois.
Hello.
Before we go any further, can I ask you if you own any of these stocks that we'll be talking about?
No, I don't know personally any of these stocks.
Okay. I'd just like to point out at this stage that none of this is investment advice, and anything learned from this video, you need to match that with your own personal research. Lastly, could I ask all of you to, if you want to support us, please subscribe and like this video. Thank you very much. I thank you in advance. I noticed that the beta for the Magnificent Seven is slightly less than 1.5, which I was surprised it was quite low. I'd have expected it to be higher than that. Obviously, these stocks are very sensitive to the earnings and the broader economy. If the broader market goes up by 1%, these stocks as a group will go up by 1.5%. What is the earnings of these stocks affected by?
Mainly, I would say, first of all, by the fact that you have this artificial intelligence revolution that is underway. That's the first thing. It has induced significant expectation about the ability of this new technology to be really disruptive. So this is the first point. And this is what is leading, at the end of the day, the momentum on the Magnificent Seven since October 22. And that was the first element. The second element that will be key down the road will be the ability to see that AI is really filtering down the rest of the economy, because this is where you have a lot of expectation. You need to prove that this technology is really disruptive, innovative, and that companies that are not Magnificent Seven are going to use this technology to improve their productivity, to really favor stronger growth in the medium term. So it depends on the one side on the ability of the momentum to continue, and second, about facts in the rest of the economy that it is filtering down.
A few people have compared the current AI mania to .com. I came across a 5 times leverage Magnificent 7 ETF just a few days ago, in fact. Is this indicative that there are similarities between what's happening at the moment and the .com age of the early 2000s?
A difficult question to answer, but I would say that there is a huge difference. What is very important is that among the Magnificent Seven and the .com, there is a huge difference. The difference is the fact that today those companies are strong grower. They have cash flow, they generate cash flow, they have strong growth. It was not the case, and they have profitability. It was not necessarily the case in the 2000 era. And so I think that this is a major difference that people needs to keep in mind. Moreover, you mentioned that the ETF 5 times exists today. At the time, in 2000, you didn't have those kind of instruments on the market. So I would not make anything about the 5 times ETF, except that it tells you that investors are very interesting to make the most of the current environment, and that could be dangerous because sometimes this is the way you favor the development of a bubble.
Coming to the other extreme, then, it's very difficult for investors to stay diversified using normal products. For instance, if they buy a spider ETF, that's not so diversified at all. Can you just explain that to us, please?
At the end of the day, when you look at the weight that today some companies, the Magnificent Seven, represent in the index, if you own the stocks and you want to diversify by saying, okay, I sell my own position and I purchase the ETF Spider, then what you are doing at the end of the day, you are reinvesting 30% of your assets into the same companies. So if you have to make a choice because you are frightened by the fact that the market went too far, too fast upward, the best option you could have maybe is to say, okay, I want to really diversify myself through something that is equally weighted, and you have the ability to have ETFs that are equally weighted and not market cap weighted. And this is maybe the best way to diversify if you really want to go for this kind of move.
There's been some volatility recently. For instance, Nvidia went down quite sharply over a few hours. In fact, would you say would you say that the market will start to react negatively to these stocks only matching earnings expectations rather than beating them?
I think the threshold is very high. They really need to continue to deliver. And so people, that's the reason why you will have a lot of focus on the growth that they developed over the course of the second quarter, but also on the guidance they will provide the market with. And that's something that's very important. If they only match, I think that there will be some kind of disappointment, considering the fact that the momentum on those stocks and the investing momentum, people want to purchase those stocks. I think that that would be a negative. But never forget, we are facing companies that have strong momentum. So it means that they are still facing the global condition, which is any setback is an opportunity for for the time being for people to purchase the stock. So we are still in this kind of environment. This is only if you have really strong disappointment about the growth and especially about the guidance that maybe people will reassess this kind of general attitude that is around the Magnificent Seven lately.
Therefore, if for those who are not concerned by a fear of missing out, those who are invested and have been for a long time, what is the volatility like on these stocks? Is it worthwhile, for instance, using covered call strategies?
I don't think so. I don't think that covered call is the right strategy. At the end of the day, today on the market, the volatility is quite low. If you had one opportunity because you made huge profit and those kind of thing, I think that what could be the best strategy is try to protect your gain. The market, is up quite significantly. We are up nearly, I think, 27% since the lows of October last year. We have reached a level of 5,500. Remember that in April we were nearly testing 5,000. So I think that people, if they want to do something, they should consider that maybe it's time to book some profit because the summer is going to be a period where volumes and market development are not going to be that great, and that the potential on the market is to a large extent already in the prices. So I think that it would be the best strategy. In a way, you can benefit from the fact that volatility is low and it allows you to protect yourself, to protect your gains in a cheap way.
So you are more veering towards taking some of the risk off the table and coming back in September after the holidays.
I don't know. I will not set a date. I think the question that you need to have in mind, to my point of view, is what is the potential of the market? Lately, you had some major houses, not to mention them, Citigroup, Bank of America, UBS. Those companies have raised their forecast about the end of the year target on the S&P 500, 6,000, The average, if you look at those targets, it means that you have nearly 10% from the current level to the year, knowing that since the beginning of the year, we are already up 15%. So there is something that you need to keep in mind. It's always dangerous to push your target because there are some elements that you need to take into account. On the one side, the interest rates and the liquidity. On the other side, the earnings. And this is the reason why this earnings season is going to be very important to my point of view and watched very closely by investor. So it's not the time. It's at what level do you want to invest? At what level do you consider that there is still a good opportunity risk level? And I think that's what people need to have in mind. It's not the time frame that is very important. And as long as you remain in a scenario as we had over the course of the last few months, you remain in a scenario where soft landing is still a high probability, you should not consider that it's time to get out of the market completely and try to say, okay, it's over. No, but you have phase where you can have consolidation. Remember what happened in March, April this year. Suddenly you had the Nasdaq losing between 6 and 9%. And it was a time where people considered that it was an opportunity to purchase. It's not the timing, it's the level you want to enter.
Okay, Francois, thank you very much for that. I think that's all we've got time for. Thank you for joining us.
You're welcome.
Bye-bye.
Bye.